why does the public education system not teach the Declaration of Independence? They'll talk about all kinds of other things, but they will not discuss the American Declaration of Independence. Because the American Declaration of Independence very clearly says that it is the people's duty to overthrow a tyrannical government. The duty of the people to overthrow a tyrannical government. Therein lies the purpose of the Second Amendment. It's not about anything else. Our Second Amendment is so that we can be well armed in the unlikely event that we ever have to 1776 again. Right? Our founding fathers had literally just fought a Revolutionary War. They understood the value of the people being well armed. In fact, little history note, the battles of Lexington and Concord that started the Revolutionary War, those were fought over munitions depots. Lexington and Concord are where the colonists had their guns. And the British understood that if the colonials were well armed, they had a problem on their hands. So they tried in the middle of the night, they tried to go take the guns. That's where the infamous "the British are coming, the British are coming," because they had a system set up because they feared that the tyrants would come try to take their guns. Well, does that sound a little familiar? Does that sound like something that maybe we worry about today?
I get a lot of questions about what this is over my back shoulder. It's legitimately the Declaration of Independence, because for some reason, we don't read this. We don't read our Constitution. And quite frankly, I know I have more to learn about our own Constitution, but that is the bedrock and foundation of what we are founded upon. It's why we're a constitutional republic. The problem is nobody understands the power that you have, because if you understand this, if you understand our US Constitution, you become powerful because you understand what rights you have. You no longer can just go around and be a sheep to whatever it is that people tell you to believe.
Greetings, empowered investors. I am coming to you today from Tampa, Florida, where we were just told we have to evacuate the hotel. What a hassle. This is now the second time at this same exact hotel in a few years that we've been told we have to evacuate because of the hurricane that is coming in. And, I think this hotel is going to be just fine through a hurricane, but if there's a big storm surge, the ground floor could flood. So got to move to another hotel for the last couple of days here in Tampa. What a hassle. But I guess there could be bigger problems. That old hashtag first world problems, right? Could be worse for sure. All right. I wanted to share with you an important study that is just out. Might go into a little bit more depth on this in a future episode, but here's the quick overview. The average homeowner just gained another $25,000 in equity. I know, all of the crash bros, the clueless, alarmist, Chicken Little, sky is falling doomers keep saying the real estate market is going to crash, and they keep being wrong. Now, granted, all real estate is local, and there are certain markets that are experiencing pretty significant inventory increases, even back to the pre-COVID levels in some cases. But remember, the pre-COVID level of inventory is not high inventory. It's not even normal inventory. The pre-COVID era in 2019 still had inventory levels below normal, quite substantially below normal, actually. So remember my metaphor about the kitchen sink. Visualize your kitchen sink and think of it like this. The faucet is new inventory coming onto the market. The basin of the sink represents the existing inventory on the market, and the drain represents the buyer demand, or the absorption rate. How many properties are buyers buying and removing from the basin of the sink or removing from the marketplace? Well, right now, if we considered the basin of the sink to be, if it was full, if the water was just at the top level, at the rim of the basin, then that would be a normal market. If it was overflowing onto the countertop and onto the floor below, that would be a buyer's market, a market that most people would consider a quote unquote bad market. I have more things to say about that, but we'll just leave it at that for now. So that's the compared to what answer. But what we have right now is we have a basin that is only half full. Now, this is most markets. This is nationally. Of course, there are some exceptions locally in certain cases. And as I always say, always ask yourself when you look at a chart, an article, or hear someone say something, always ask yourself, What aren't they telling us? What are they not saying? Well, what they're not saying in this article, well, maybe I'll just go through the article a little bit and show you a handy dandy chart here that's interesting. And then I'll tell you what they're not saying. So it says Maine, California, and New Jersey led all states' annualized home equity gains in Q2, according to CoreLogic. Home equity continued to rise for the second quarter of this year as residential properties with mortgages, that's one of the things that's really important to notice, with mortgages gained another 1.3 trillion, that's with a T, $1.3 trillion in equity over the past year. But growth began to slow during these 3 months, according to CoreLogic, a homeowner equity insights report, which is the report I want to go into on a future episode in a little more detail. Aggregate equity gain was 8% year over year. Remember, the one thing you absolutely, positively must have to have a real estate crash is tens of millions of distressed homeowners, those people that can't afford their payments, those people with very low equity or negative equity being underwater. You got to have that. You got to have tens of millions of those people that become millions of distressed home sellers. We are so far from that right now. We have the complete opposite situation. And I've explained that before in prior episodes. But all of those doomers somehow find a way to say, this isn't the way it is. Yet they keep being wrong over and over and over again. So don't listen to them because they're going to make you miss the opportunities. Look, there will be little fluctuations in certain submarkets at certain times. This is the nature of any marketplace. But the overall macro trend is housing shortage, high demand, end of discussion. Prices soften, more upward pressure on rents because people aren't buying, they're staying in the rental pool. Prices increase, appreciation. You win either way. It's a multi-dimensional asset class. Okay, so let's look at the chart here. So in Florida, they gained an average of $22,000. In California, they gained an average of $55,000. And in Washington State, $41,000. And in Alabama, $11,000 in Alabama. Georgia, $18,000. So what is this not telling us? Well, the gains, to be more accurate, should be expressed in a percentage number rather than an aggregate dollar number, because relative to the price of the home, the gains expressed as percentages, that would be an accurate way to look at it. But what's only expressed as dollars, you might think, oh my gosh, California, Washington State, those are the best places to invest. New York up $30,000 aggregate, right? Those would be the best places to invest. No, they wouldn't, because those properties are much more expensive. The basis at which you're starting is dramatically higher because those properties are so expensive. So compared to what is always the right question to ask. What markets do we like right now? Well, I'm only going to mention it by states. And within the state, of course, there are many submarkets and they vary. So we don't like every market in every state, but just very generally as an overview, Indiana is going great. Some Florida markets are going great. Some are experiencing a little bit of increased inventory back to pre-COVID levels. Alabama, fantastic. Tennessee also. And we have other markets around the country that we like as well. But those are kind of the prime focus right at the moment. And you can see with this map, if you're looking on video, you can see the state by state dollar amount of inventory gains. So what else does this go on to say? Well, Selma Hepp, the chief economist for CoreLogic, who's been on the show before, that was if you're interested in hearing what she has to say, go and look up that prior show with Selma Hepp. That was a really interesting interview I did with her. Said in a statement that home price growth has continued to fuel overall equity gains, with existing homeowners now averaging about $315,000 in equity. People, empowered investors, and doom and gloomers. That is an absolute record high right there. $315,000 in equity. I mean, the padding, the cushion in this particular market is ginormous. There is a huge cushion. There is not yet There will be someday. But at the time of this recording, there is not a concern of a crash. It's just not there. I mean, show me the data that supports it. I love these people that make these hit and run comments. Oh, you're wrong, you know, blah, yada, yada, yada. But they have no data. They don't show any data. And when they do occasionally share some data, it always leaves important other data out. And that's the important thing to note. The article goes on to say, this is nearly $129,000 higher than the average equity per homeowner recorded at the start of the COVID-19 pandemic in 2020. Quote, the substantial accumulation of home equity for existing homeowners has served as an important financial buffer in times of uncertainty, as some homeowners facing higher costs of homeowners insurance and taxes, well, of course their taxes are higher, their property value has gone up, and those two are indexed to each other. So, you know, when you got your property value that you've made a bunch of money on, you got to pay a little higher taxes. That's just going to happen that way. And have had to tap into their equity to prevent falling behind on their mortgages, Hepp explained. Quote, as a result of mortgage delinquency rates have remained at historical lows, despite the inflationary pressures and higher costs of almost all non-mortgage homeownership related expenses. Now, the next thing it talks about is the underwater issue. Negative equity, that's underwater, which refers to underwater mortgages or those with higher mortgage balances than the home's value, continued to see modest declines, not increases, declines. In other words, fewer people have negative equity and more people have very, very, very positive equity. On a quarterly basis, the number of homes with negative equity fell by 4.2% to 1 million and now account for about 1.7% of all mortgage properties in the US on an annualized basis. The decline reached 15% or 1.1 million homes. So this is great news. Less negative equity, more positive equity that provides a really good cushion. But you can't hear the dogs that don't bark, as I always say. What dog isn't barking in what I just told you? Remember, always ask yourself, what are they not telling us? Well, what they're not telling us here is they said that this negative equity number was applicable to all mortgaged homes. And that would be fine because that's the only place it would really apply, because that's the big encumbrance on a property that would make negative equity or an underwater home. But wait, 40%, give or take a little bit, of all homes in the US have no mortgage at all. So if you were to take all homes and look at the negative equity numbers, they're dramatically smaller than I just explained. A lot of cushion in the market.